Hey everybody, I want to welcome you to the CamaPlan webinar today, leveraging your IRA with non-recourse lending. We're honored to have North American Savings Bank, Jason Zook with us today. I kind of consider NASB a leader in the mortgage industry, especially with self-directed IRAs and non-recourse loans. I started back in the 2003, 2004 era, and I've been working with them ever since. They've got $2 billion in mortgages per year for home purchases, mortgage refinance, reverse mortgages, etc. And Jason will take a few questions today. So if you have some questions, I want you to put them in the question box and we will get to them. If we don't get to all of your questions, Jason's going to give us some contact information where you can contact him. Jason is a Senior IRA Loan Consultant with North American Savings Bank, and he's worked with thousands of self-directed clients over the past 10 or 15 years, and he helps everybody facilitate their transactions. He's originated more IRA non-recourse loans than any other loan consultant in the nation, I believe, at this point. Jason's insight and experience was invaluable in launching the first nationwide non-recourse loan program and has grown it to quite a size, like I said, as an industry standard. He uses his creativity and expertise to help self-directed clients maximize their returns with real estate. So at this point, I'm going to read a disclosure before I bring Jason on the line, and just so everybody understands it, everything here is supposedly going to be educational. The views expressed by the speakers at these CAMA webinars are those of the speakers only and may not reflect those of CAMA, its members, or employees. CAMA does not guarantee the accuracy or information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented, right? We encourage you to bring professional advisors and have them watch these webinars. We will record this webinar so that you can see it in the future and bring it to any of your advisors that aren't here. CAMA absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA, its members and employees do not accept liability for losses and or damages arising from errors or omissions within or reliance on any information provided by the speakers. Individuals are strongly encouraged by CamaPlan to conduct their own due diligence before making any investment choices. CAMA does not act as nor offer the services of an investment advisor, nor a CPA, nor a realtor, nor an attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, please hire the services of a competent professional. Seek them out. So at this point, Jason, I would like to welcome you to CamaPlan, and if you can, take the screen and bring up your PowerPoint, and we'll ask the questions later.
That sounds great. Hey, thanks for having me, Carl, and hello, everybody. My name is Jason Zook. I am with North American Savings Bank and have been so since 2003. We are the nationwide lender for IRA non-recourse loans. And how we got started was actually back in 2003, we had somebody come into our bank that was buying a couple duplexes, and they had 50% of the money to buy these duplexes inside the retirement account and wanted to see if they could lend the rest. We had not heard of this before that time, and hired an attorney and actually put together the first national non-recourse loan program. We ended up writing the book on it and are the nationwide leaders today. So today we're going to look at,
Hey, Jason, can you put that
yeah,
slide back up and just tell everybody what your phone number is, if you don't mind, so that
yeah,
people that are listening in the future can get a hold of you and not necessarily call us as information, trying to
definitely.
get your phone number.
The main 800 line to get to one of us few loan consultants is 866-735-6272. And if they need to go to our website, it's iralending.com, or you can email me directly, and it's jzook@nasb.com. So jzook@nasb.com. And I'll show the slide at the end as well. So if anybody didn't catch that or wants to write it down at the end, we can take another look at that.
Thanks, Jason.
You bet. So today we're going to look at the advantages of using debt financing to buy real estate inside the IRA, how you can actually apply and receive a non-recourse loan, and what the guidelines and parameters are for a non-recourse loan through North American Savings Bank. We'll look at things like interest rates, cost involved, the type of property that we approve, and an example of how we determine loan eligibility. A big way for us to do that is for the property's expected cash flow. So we're going to look at the expected market rents of the property divided by the expected expenses, and we'll go through an example of that today as well. So North American Savings Bank, who we are, we've been around since 1927. We're based out of Kansas City, Missouri, and we do offer a variety of mortgage loans beyond the non-recourse loan. It is the only thing that I do. So I don't handle any of the conventional loans, so I am here as a specialist to just work with you on how to obtain this and help you qualify for that. So let's say you open up an account with CamaPlan and you don't have enough money in your self-directed IRA to buy a property free and clear. Let's look at what options that you can do. Let's say, or you don't want to put all your eggs in one basket. Instead of buying one big property with all your money, you can actually use it to buy two properties or use that money to buy something else in your retirement account. So that's what the non-recourse loan can do. It can help leverage your purchase to allow your money to do some other things that maybe you couldn't do before. So a non-recourse loan, basically, Publication 590 from the IRS states that you cannot use your IRA as security for a loan. This does leave only the one option, and the reason most other banks won't offer this type of loan is, A, they don't understand it, or B, it's a portfolio loan. So a bank has to keep all of this money in the loans in their portfolio. They can't sell these off, or they don't sell these off like traditional loans. Most banks will offer a loan, collect the fees, sell the loan off. We don't do that. We have tens of millions of dollars in our portfolio of these types of loans, which other banks may not want to do. Or maybe there's not enough volume. A larger bank, Wells Fargo or someone, just not enough volume nationwide to really put something together. So we were the only bank to even offer this nationally for many years. We wrote the book on it. We're still the experts today. And if you'd like a free copy of that ebook, you can definitely contact me and let me know. I'd be happy to send that over along with the current loan terms just so you can take a look at it and get comfortable with everything. So non-recourse loan is a loan in which you as the IRA holder are not personally liable for repayment of the loan. It allows no recourse against you or the IRA, only the property in itself. So in the event of default or foreclosure, the lender can take back the property, and if you had any kind of down payment into that property still, you would lose that, but it would not affect your credit or you personally or anything with your IRA. The bank can only take the property back. Some advantages of using debt financing within the self-directed IRA are that all the net proceeds go back into the IRA. So if you have a Roth account, you already paid taxes on those funds. Any income or appreciation you develop in that property all goes back in that IRA tax-free. If you have a traditional loan, it's all tax deferred. So you are taking some tax advantages by buying property inside the IRA and then also leveraging it. Leveraging your IRA allows for larger gains inside your retirement account. As I mentioned, it allows you then to buy either multiple homes or maybe a larger home that you couldn't afford before. So who is eligible for a non-recourse loan? Basically anybody that has at least 30 to 40% down of the purchase price in their retirement account. So if you've taken out a conventional loan before, you know that they may require anywhere from 5 to 10% down, some cases 0% if you're a veteran. But on this one, there's more risk for the lender. You can walk away at any time with no recourse against you. So we do have that larger percentage down. I'll give you an example. After the decline there in 2008, 2009, we actually did take back many homes. If the property value went down, more than 30 to 40%, some people just walked away. Why are they going to keep paying if that property went away? Or, maybe there were some foreclosures on the street that drug down the market on their property as well. So there were some issues back after the decline. But now we lend really based upon the property's cash flow. We want to make sure that the property can stand alone on the market rents divided by the expenses. So even in an event of another downturn, you should be able to keep the property and hopefully not have anything too crazy happen on you. So as I mentioned, the minimum down payments are 30 to 40%. On a single family home, we can look as little as 30% down. On a multi-unit or condominium, we typically require at least 40% down. We're going to look at things like property curb appeal, property size, the age, the expected cash flow, history, and not your income, assets, or employment. Very document-friendly loan. We won't have to collect hardly any personal information at all. The only thing personally that we do is we do pull your credit to see if there are any liens on that report that could affect our property, or if there's a history of mortgage lates. We can get by those on the right property. If management likes the property and the equity position, we can definitely take a look at that. We only lend on properties that are in decent condition. If it needs a lot of work, you may have to get some kind of bridge loan. Since we can only take back the property itself, we do want it to be in decent condition. If it needs some updating or some cosmetic work, that's not a problem. We will have an appraiser go out and perform a full inspection on the property if you decide to continue. And they'll do a sales comparable as well as the rental comparable. So we'll all understand kind of what that expected income can be.
Hey, Jason, back when we started on it, when a place was in rough shape, you guys made sure that there was more money in the account to bring it back up to, basically reserves in the IRA to bring it up to standards, but would still give the.
Yeah, and we still do that. We do want to see a little bit of reserves in the account. We have plenty of people that will buy a home, whether it's short sale through a bank or maybe it needs a little bit of work, and that's no problem at all. If it needs updating, cosmetics, things like that. If the property is inhabitable or just really bad curb appeal or looks like something we wouldn't even want back, we won't lend on those. So that's really our mentality on that, is looking at it and say, if we had to take this back, would we want it in its current condition? If not, the seller may have to make some repairs, or you may have to, as I mentioned, get a bridge loan if it's really bad. But we don't lend on fix and flips either. Our loans are really based upon property that will be held as rental income. So we can usually tell if property is in really bad condition and might be flipped. We're really not getting into those.
I got you. Thanks.
You bet.
Sorry to interrupt.
Oh, please. Any questions during the please here, let me know. As far as your purchase contract, your title work, your insurance, all has to be in the name of CamaPlan. It'll be Cama, Self-Directed IRA, LLC, FBO, your name, IRA. We'll make sure that your name there matches their statements. We'll get the insurance, the title work, contract. We'll get everything. We'll do all of that for you. You won't have to worry about any of that. If you buy something outright through Cama without a loan, you'll notice that you may be required to use your account numbers at the end. We don't allow that if the mortgage is involved, just for some recordable documents on our end. If the contract's wrong up front, no worries. 90% of the time it is. We'll have your agent just draw up an amendment correcting it, and everybody can sign it at closing. So our goal is to make this as simple as possible for you. So we can finance property in all 50 states. I will tell you, New York is a little challenging right now due to their foreclosure laws and process. So it'd have to be the right type of deal in New York. We don't lend on anything offshore, only the actual states. And you can still buy property offshore and outside of states, but you'd have to do it in cash. A bank does not have the guidelines to be able to go overseas and take property. So that is where the issue comes in for the non-recourse loan there. The processing time frame for a non-recourse loan is right about 30 days at this time. On a cash out loan, we can actually close in an even shorter period of time. This is typical for the mortgage industry. And at closing, you'll notice the differences are you'll actually go into the title company and sign everything as read and approved. And then those documents will be overnighted over to CAMA. And CAMA will execute the entire loan package and overnight it back to the title company for funding. So there is a couple-day lag time between you actually signing as read and approved and then the loan funding. And so that we'll make sure everybody's aware of that up front so there's not any problems at the end. The types of loan programs that we have available. We have a 5-year ARM, a 10-year ARM, a 10, 15, and 20-year fixed loan. So the 5 and the 10-year ARMs are fixed for 5 and 10 years respectively, and then would adjust annually after that. It can go out over a loan period of 20 to 25 years, and on more expensive properties, most people will use an ARM just to get it out over that 25 years and lower their mortgage payment. On the fixed loans, the longest fixed period that we offer is 20 years. The interest rates start in the mid to upper 5s and go through the lower 6s. The lowest rate we offer is 5.625%. The highest is 6.25%, and there are multiple loan products in between there. And these loans do not change very often. I think we've had one change in 2.5 years, so it does not change like the conventional market. These are each principal and interest payments, and we do have a minimum loan size of $50,000, minimum purchase price of $80,000. And as I mentioned, these are a little bit higher in traditional loans, but they're not exorbitant, and they're much better than your other options, which is hard money. And before we came around with the non-recourse loan, that was really the only option out there. Unless you could find some private financing, you're talking 10 and 12% for these types of loans. So for us being a federal bank and be able to start these in the 5s, we still feel pretty good about where our place in the market is.
Hey, Jason, one question on here is if you have 2 or 3 properties and they're not at 80,000, but together they're like 120,000, would you be able to loan on all 3 of them?
Unfortunately not. We don't offer any kind of blanket loans or combined property together. Each home does have to meet the minimum requirements. So if you found a home for at least, that 80 to 85,000 area and we're able to bring in, 30 to 40% down, that would put our minimum loan amount. It would meet our minimum loan amount of $50,000. Unfortunately, we're not able to combine properties to meet that though. I actually own some smaller homes myself here in Kansas City, and I'm not able to get financing even myself unless I wanted to go the hard money route, just because of where they lie in that respect.
No, I got you. And there's people in that same problem up in the Detroit area that were buying houses, and we sent them there. So I just wanted to know if there was a way to do it. So that's great. Thanks.
You bet, definitely. Which leads us right into the next option, which actually is cash out refinance. If you own property already inside the retirement account, you can also then come back and get cash out and free up some of that equity to, buy more properties or do whatever you'd like to do with that funds. Some people, they're not aware of the non-recourse loan when they bought the property outright, or they had to close early due to time constraints. Or maybe they even got a hard money loan and didn't know about us. But on a cash out loan, we will lend up to 60 to 65% of cost or up to 50% of the new value. And we also look at, the things like normal curb appeal, size, age, and cash flow. These funds just go right back into your retirement account. It allows you then to, purchase other properties, or what a lot of people do is they'll bring us a house, we'll lend on it. The money goes back in the IRA, and they'll simultaneously use that money as a down payment for a purchase and a loan on the next property. So now you have 2 homes, 2 loans, where maybe you only had one before with no loan on it. So the properties that we can lend on are the single family homes, condos, townhomes, multi-units. We do also have a commercial division. I don't handle that, but if you have commercial property, we can take a look at that as well. We can look at unwarrantable condos actually as well. With these, since it's a portfolio program, we really make the rules. We're not selling these off and have to conform to the standards of selling loans. So you can really bring us anything on condos as long as there isn't some legal issues that are affecting our unit. We really don't have much issues lending to it. The ineligible properties include large acreage or raw land. Raw land isn't receiving cash flow unless it's agricultural. So we just don't look at anything that's too unique. Manufactured homes, hotel, timeshares, things like that. We don't do any kind of construction loans either. bank would only be able to come out after the construction materials, which it wouldn't want to do. I do have a lot of people that buy new construction homes though, and we can, the builder can start the process. We can start an appraisal process about 60 days before the property is completed, just to make sure we're ready to give that permanent financing loan as soon as the property is completed. We have a lot of people doing that. As I mentioned, we don't do any kind of fix and flip or homes that need a lot of work though. So let's go through a quick example of income requirements for a property. We normally want to see that the property will cash flow by 20 to 25% positive amount. The three things that we are looking at is the property itself as collateral, your IRA account to see what kind of down payment and reserves that it has, and then that expected cash flow. We want to see that it can go 20 to 25% in most cases. So in this example, you have a $180,000 purchase price, assuming that the property will get $1,600 a month in income. If you annualize that income into $19,200 and take out some expected expenses, the actual expenses would be taxes, insurance, and possible property management. But in our analysis, we also use things like vacancy and maintenance repair. We're just kind of doing a more conservative cash flow analysis on our part. So after deducting these items, your net operating income would be just a shade over $14,000. So there's that $14,000 number again. If we did a 60% loan, for instance, that would be a $108,000 loan. I'm using a 5/1 ARM here at 5.75. The principal and interest total payments for the year on that would be $89.15. So if you take your net operating income of $14,064 and divide it by your actual expenses there, this gives you a 1.57 debt service. Kind of layman's terms, what that means is 1.0 is break even. We want to see 1.2 to 1.25, and yours is way above this. So this home would definitely qualify for at least a 60% loan. Now, if you want a shorter loan period, like a 10-year or a 15-year for whatever reasons, we can make exceptions to this debt service coverage ratio. We do also make exceptions to this on, for instance, homes in California. The values are outpacing the rent so much that once somebody gets down to a 50% loan amount, really regardless of cash flow, we'll lend on it just because of the equity position that we have on it. So the debt service is just more of a guide for us. And I'm happy to go over property scenarios with you and send you a payment cost worksheet to show you how that works as well. The other costs with the loan, on a cash out, these actually come from your loan proceeds, so you won't actually have to pay anything. On a purchase, these are the ones that have to come from your IRA at closing, though, unless you get a closing cost credit from the seller. These include a 1% origination fee based upon the loan amount, and then $895 total in processing and underwriting. Those are the bank fees. Beyond that are your title company costs, title company of your choice in your area. We don't know exactly what those are going to be. Your appraisal, and then we do escrow for taxes and insurance. We'll escrow and impound those just like a traditional loan. We'll put that into your payment, and we'll take over making those tax and insurance payments. As I mentioned before, I can put a worksheet together for you to review to see if it even makes sense for you to do. No problem at all. The documentation required for loan approval, very simple. I can take a one-page Word document from you that has some property information, get you a loan decision within a couple of hours. From there, after your review, if you decide to continue, we need about 30 days to close, and we'll just collect a loan application, driver's license, IRA statements, purchase contract, and appraisal funds. Pretty simple. So you can check out our blog at iralendingblog.com, or there's a podcast and other information on that iralending.com website that I mentioned. And also, here is the bank number again that will get you to one of 3 loan consultants, including myself. Feel free to contact me directly at jzook@nasb.com. And if you want a free copy of the ebook, you can let me know that as well. And that concludes the presentation today.
Hey, Jason, on
your questions, definitely, please.
Yeah, on your ebook, what do you want them to do? Call you or email you or both of them to get the free copy of the ebook?
Yeah, I'll tell you what, the best option is just to email me, and I'll send back a frequently asked questions brochure, the ebook, and where all the current loan terms are as well, so you can just have everything all at once. If you want to talk to me directly, feel free to do that as well, and then I can send it over. But if you just want the book and FAQ items, feel free to shoot me an email.
Great, thank you. If anybody has any questions, go ahead and put them in the question box, please, and we'll read them out. One of the questions here is there a prepayment penalty? CAMA doesn't pay much on their money in the when it's sitting at CAMA. Is it possible to prepay some of the interest monthly instead of having it sitting in the account?
You bet. Good question. No prepayment penalty. You could pay off the loan at any time. You can add as much principal payments at any time as well. So no prepayment penalty at all with this type of loan.
And whether it's an ARM or a fixed, it makes no difference.
Makes no difference to us.
Okay. And another one here is there a number of loans that they can have with you?
There is no maximum. There used to be after the decline, but there is no more. In fact, I have a client now that has 9 loans with us. She actually buys property in the neighborhood of probably 90,000 to 120,000, gets 60 to 70% loans, and now owns 9 properties through her retirement account. The only real limitation is how much money do you have in your account. We just want to make sure there's a little bit of reserves left. We're not going to require a set amount of reserves for every property. If you got multiple cash flowing properties, we just want to make sure there's a little bit of reserves to service that debt.
Okay. And I mean, I do see some of our clients, they like you said in the beginning, they'll leverage 2 or 3 properties because they'll get a better cash on cash return versus just paying cash for one property.
Definitely. Very firm believer in that. If you can get 2 or 3 properties instead of one, you know, that appreciate, if the home does appreciate and you're getting the rental income also, I mean, that's a huge advantage for your IRA.
Okay. What would be considered large? What would be considered large acreage? Over 1 acre?
Over 3 acres, and we can still lend on greater than 3 acres, and we have. We're just looking really at the property then in that location, the area. If it's a real rural area, you know, it's a little more difficult for us to lend. We may only offer 50% or not at all depending on, you know, those property factors.
Okay. What else? Let me read this other one here. Do you have a maximum loan size?
There is no maximum. You know, as I mentioned, in places like California and some other places, we may only offer a 50% loan on much larger price property just because the cash flow may not be there, but there is no maximum loan amount.
Okay. Do you do commercial properties? I saw 5+ units.
We do. Now I can help. I can help on 1 to 8 units. Anything greater than 8 or commercial property has to go through a different department, and I'd be happy to put you in touch with them as well. Some of the commercial requirements are minimum $500,000 loan, typically a minimum 40% down as well. So the minimum purchase price is around $850 with a minimum loan of about $500,000.
Okay, great. On a cash out, are you looking for an appraisal of $80,000 based on your requirements? It has to be $80,000 or more.
Yeah, we're looking at what you paid for the property. We can also look at the value today. But our difficulty is if you bought the property for less than $50,000, we're probably not going to lend on that home because we don't lend greater than what you paid for the property. We want to make sure you have some skin in the game as well on that whole walking away factor. So if you bought the property for say $80,000 and it comes in at $80,000, great. You know, then we can look at doing that minimum $50,000 loan amount. We do have that 1-page eligibility form if you'd like to have us take a look at it to see if we can do that. But for the most part, any home that has been sold anywhere around $50,000 or less, we normally can't do much with it.
Well, let me bring up this because I thought you guys had done this for one of our clients. They bought the property for, I think, like $40,000 and put in $100,000 to upgrade it, and then it was appraised at like 180. Even though they bought it for 40, you guys gave them the appraisal and I think gave them like a 60% loan to value.
Yeah, it is possible, definitely. In an extreme circumstance like that, we don't run into that a whole lot. But if you buy a property near that amount, you put a lot into it, we can document those costs.
Yeah, no,
We
they
can have,
gave you the, yeah, I think they gave you the
yeah,
contract and and we showed you the money leaving the account and stuff. And
yeah, it
obviously
would
the
be a max
house
of
was a lot nicer.
60% of, we can take a look at the total cost. So the total cost is 140 in that case, and typically can lend a max 60% of that, or up to 50% of the new value. So 50% of the new value in that case might be in that $90,000 range. 60% of cost is around 80. So we're probably in that neighborhood of 80 to 90,000 max in a situation like that. You know, also the bank's just going to look at property location, property curb appeal, size, age. If all those come into play and we can document those costs, it's definitely something we can take a look at. But we won't. It'll be difficult for us to lend on a home that only is 80,000 cost and was purchased for less than 50. Management doesn't have a whole lot of appetite for those.
Gotcha. Do you, do you talk about UBIT on a refinance versus a first time purchase?
You know, not being a tax advisor, they asked me not to comment a whole lot. However, in that ebook that I can send you, we have an entire chapter devoted to UBIT. For the most part, if you are using your property as just a passive rental income from year to year, you shouldn't have to pay UBIT from year to year as a passive rental investment. People get in trouble more with the tax when they go to sell it if they still have a large loan, or if they're flipping a bunch of properties every year. You know, once you turn your IRA into a little business like that, then it's going to have a little more tax consequences compared to just passively and getting rental income every year. Because when you do it that way, you can line item depreciation and taxes and insurance. And in our book, Chapter 6, are examples of that as well that I'd be happy to send over to you.
All right, and they will contact you at jzook, JZOOK, at NASB.com, NorthAmericanSavingsBank.com. And your phone number is 866-735-6272.
Correct. And that 800 number will get you to one of the 3 loan consultants. You could always ask for me if you're more comfortable with me, but they can help you just as well.
Okay, so they don't need to talk to you to get the book. They can talk to one of the tax consultants.
All right, so there are actually other loan officers. There's 3 of us, and if you call and talk to,
I didn't mean tax consultants.
No problem. If you do call and talk to any one of us, any of us can email that book over to you. No problem.
Okay, Jason, do you have any parting words for our listeners today and what they should be looking for and non-recourse lending?
I hope I excited some people out there. I firmly believe in this. It's fun to do something you really believe in. I enjoy helping people every day. So there's no dumb questions in this. A lot of people are new to this, so feel free to ask questions. Have fun with this. This is your investment account, and please let us know if we can answer any other questions. Even if you don't need a loan, feel free to call us, and we'll be happy to try to point you in the right direction.
Jason, I want to thank you very much. This has been helpful. It's good information, and I appreciate you taking the time and educating our listeners and our clients. And I look forward to continuing our success working together here in the near future. And I'm going to probably write you right after this just to take a look at that ebook. I have your, or actually Matt's book, Leverage Your IRA, and we've handed those, thousands of those out to clients here at the Cama Academy. So yes, it is good, and I haven't seen your ebook, but I'm going to get it.
Definitely, I can send that to you, and feel free to pass that out to whoever would like it as well. And I appreciate you having me on today, Carl. We've been working together for many years as well, and hope everybody out there receives some information that they'll be able to work with.
All right, let me just make sure we don't have any more questions on here. Carl, what is the book and author you mentioned? Is it Keep It? Is that right? The book we're talking about today is Leverage Your IRA, and it's by Matthew M. Allen, Allen, Leverage Your IRA. The other book you're talking about, Keep It, from one of our previous webinars, is by Joe Luby, and we always tell you to read Keep It if you're going to convert your IRA and your loan, et cetera, to a Roth IRA. And that is another good point, is because if you do put a loan on a piece of property and then convert that property, the value of the conversion is the value of the property minus the loan, which will save you some taxes going forward, or right then when you do the conversion. So yeah, there's a lot of good things out there. Again, thank you very much, Jason. We look forward to working with you here in the near future.
Definitely. Thanks for having me, Carl.
You're welcome.